Okay, good morning, everyone. Thank you so much for joining us. We hope you're keeping well and safe. My name is Edwin Chui. I'm Head of Research and Strategy here at Diane Blair Investment Bank. Now, the Kenyan shilling has depreciated 6.8% year to date against the USD. And this is the highest depreciation we've seen in recent years. There are concerns among investors about where we go from here, given that we do not know how long the COVID crisis is going to be, and also given that we do not know exactly what the impact is going to be like. Now here at Dan Blair, as you continue to assess how to position yourself, we're very happy to provide meaningful insights that you can use towards making all your investment decisions. In this light, we're very much privileged today to have Mr. Arthur Camp from Sanlam Investments. He is the Chief Economist at Sanlam Investments, and he's going to be taking us through a presentation with his views with respect to the post-COVID-19 recovery and the exchange rate dynamics. After the presentation, we are going to have a Q&A session where Arthur will be joined by Mr. Mark Muller, who is Managing Director at Sanlam Private Wealth. Arthur and Mark will also be supported by our team here at Diane Blair Investment Bank. Feel free to post your questions in the Q&A section anytime during the presentation. We will do our best to answer most of those questions. And in the event we can't, we will be happy to share written answers along the presentation. At this point, allow me to welcome Mr. Arthur to share his presentation. Over to you, Arthur.
Thank you, Edwin. Good morning, everyone. I hope you're all keeping well. So today's presentation, the end goal of it is to try and take a view on what we think the outlook is for the Kenyan shilling. So to get there, we take you on a short little journey first, and that's just a look at the domestic economy and its ability to recover, because globally, when COVID-19 broke out, clearly that had a big impact on investors' perceptions of emerging markets' potential to keep delivering high returns. And so we saw a lot of volatility in markets. So we'll have a look at the ability of the Kenyan economy to recover and its longer term prospects. But of course, all of this taking place against a very unusual global backdrop of monetary policy, extraordinary monetary policy measures that have been implemented. We've had a level of support of fiscal and global fiscal and monetary policy that's unprecedented. And the impact of that permeates through the whole world and has implications for investment decisions around the globe. So we'll have a look at that before we finalize with a view on the main drivers of the Kenyan shilling. So just looking at the level of economic activity, what this chart is showing you, it's simply an attempt to put together an analysis of the stringency of policy restrictions that have been imposed around the world. This is put together by the School of Bladvatnik at the University of Oxford. And what they try and do is they try and collate all the restriction measures that have been put in place. So workplace closures, the schools closing, travel restrictions, stay-at-home requirements, the level of government support that is lent during COVID-19, the government response overall in terms of health and containment of the virus, public events being cancelled. So all of these events, they collate into one index, and a level of 100 would be the most stringent. And of course, then as you move down that index, less stringent. So what we can see here is on this chart, what it's showing you is that the orange squares, that is the most stringent level of lockdown in each of these respective countries that was seen during the past few months. And then the blue bar is representing the current level. So you can see throughout the globe, a lot of economies have started to open up again. And clearly that's the important thing here, because a lot of the economic downturn was a result of very necessary, but certainly as far as economic activity goes, extremely restrictive lockdown measures. So opening up of the economies is the first port of call for recovery. So developed markets have led the way, and that's not surprising because they were hit first by the virus after it came out of the emerging markets of Asia, or at least where it was first identified in the emerging markets of Asia. But through other emerging markets, we're only being hit with a lag. So it's gone through down to, from the Northern Hemisphere, it's come down to the Southern Hemisphere. And because we've been hit with a lag, we'd be obviously of those economies that would be opening up more slowly. So one can see there that Kenya is still relatively restrictive relative to the rest of the world, but nonetheless beginning to open up. And we can see here that the height of those restrictions was reached in June. And since then, we've started gradually opening up. Not as much as the global average. This global average is just a straightforward average. It's not weighted by GDP. But one can be confident that as the economy opens up, that economic activity does come back online. It is important, however, to note, if we can learn one lesson, there are a number, but one of the important lessons that we have to heed from the influenza pandemic of 1918 was that over 2 years it came back for a second and third wave. So one has to be vigilant, and one has to, in one's investment decision-making process, bear in mind that there is a possibility that once the disease starts to fade, there is the potential that it could flare up again at some point, resulting in restrictions being put back in place. But nonetheless, in Kenya, we know that the number of cases significantly above 4,000 on a cumulative basis, 387 cases per million people, and the number of deaths being six per million people. That is still significantly below where South Africa has been. South Africa, for example, has got 8,009 cases per million people and 127 deaths per million people. But just bear in mind that even if this disease does begin to fade, that it does have that potential to return. But as I say, as the economy opens up, we already, in fact, it would seem through the worst of this. So Google puts together community mobility reports, and what this does is it actually just tracks people movement into workplaces, through transport, through their shopping. And one can see here that we reached the trough here during April of this year. And as the economy has gradually begun to open up, we've seen more foot traffic through transit stations, people going back to retail stores, although it's been led by grocery and pharmaceuticals. So really the kind of basic essential materials and obviously medical type of materials that people and goods that people have been buying, not so much the rest of retail yet. The same is true actually of workplaces. People have started to go back to workplaces, but it is lagging a bit. However, one can see there from transit stations that there's a lot more movement of people, and generally the picture is one of an opening economy. So one should imagine that the second quarter, the economy will probably take its biggest hit, but that there should be improvement from the third and fourth quarters of this year. There are mitigating factors as well, relative to a number of other economies that are helpful. One is that Kenya has a high level of agriculture value added to GDP, and it's one of the areas of the economy that has tended to remain more open, less restrictive measures being put in place, and also expectations that, for example, the locust swarm would result in a really big, heavy hit to agriculture. And we've not really seen it in the overall numbers. Agriculture has been quite firm relative to previous expectations. That's very helpful. And then also on a number of other factors, Kenya's got a relatively large number of trading partners relative to many other emerging market economies. Also a good mix of commodity products, not focused, or export products, not focused in one particular area. So that also helps to mitigate the risk of having a current account deficit during a time when global capital flows are not necessarily very, very robust. Of course, the one area that one should look at is the potential for volatility, because Kenya is an economy with capital markets that the rest of the world has a significant interest in. So at times like this, of course, because you are increasingly integrated with the rest of the world, one would potentially see some volatility from time to time. We've got a lot on our doorstep. There's the American presidential election. There's China-US relations deteriorating. As I said, there's also the potential for second wave. But at least as well, one of the significant advantages that the economy at this point has must be a good improvement in its terms of trade. Oil prices sharply down, oil importer, and that's also obviously very helpful overall for the current account and the balance of payments. So a number of mitigating factors. And then importantly, it's very important to look at these cyclical factors. The cyclical factors tell us that, yes, the economy is recovering. There could be significant volatility, though. At least there are support factors. But when all is said and done, at the end of the day, investment decisions are mostly made on structural trends. And this is where Kenya does show a very encouraging environment. So this is simply GDP per capita. It's in 2011 purchasing power parity international dollars for Kenya. And one can see there the significant change that we saw from late to sort of 2008, 2010, the latter part of the last decade, a significant upward momentum. And ultimately, at the end of the day, when one looks at long-term economic prospects and prospective returns in economies, one would look at its potential to generate productivity, because growth at the end of the day is a function of how many people one can employ productively. GDP per capita is nothing more than the amount of goods and services produced per person. Hence, it's a very good indicator of productivity. And one can see here, we've tracked the reasons for this improvement. And our work tells us that it's a lot to do with human capital development, is a good explanatory variable. We use an analysis where we include returns to schooling and education, a number of years of schooling as well. Then also another factor is government fiscal policy, and especially there one can look at the level of government consumption. In the last number of years, we know that a significant portion of government expenditure has been on the capex side. Yes, that is declining, but it has been quite material. So if a government is going to spend and it's spending on capex, that is of course preferential. So that's another positive factor. And then also a number of other factors that we look at to determine success. And one would be institutional strength. And if one has well-contained inflation, which Kenya does have well within the target band of the central bank, that's also an indication of institutional strength. And finally, it's still an economy with a relatively low level of GDP per capita relative to the richest country in the world, depending on how you look at it. We look at Singapore, and economies that are in that position but implement the right policies and are productive offer high returns to investment and attract capital. So that's a positive long-term structural story, which gives one confidence that Kenya can recover from this situation. And also, it's obviously demographics. Kenya's got very favorable demographics in terms of growth in the working age population relative to the size of the share of working age population in the total population. Very favorable position. So good demographics plus rising GDP per capita, always a good story. Okay, so that's the sort of structural look at, yes, it's been very difficult. Yes, the economy has taken a very heavy hit. Yes, it would take some time to recover, but we think the building blocks are there for that to happen. So long term, when one invests in an economy, that's one of the key things one does look at is the potential returns over time. And that's why I started with this analysis. Now more to the specifics. So when we look at the potential for Kenya to and the currency in this particular environment, what is the likely outcome? There's a lot of focus at the moment on twin deficits. So if you've got a large fiscal deficit, if you've got a large current account deficit, that tends to be a point of concern because can you attract enough capital? Here I would like to point out that the deficit of Kenya in large part reflects in recent years a significant level of investment to GDP. Yes, it can be higher. We saw that around about the time of just before and after the global financial crisis, it was significantly higher. But nonetheless, a significant portion of this deficit has been capital expenditure, which adds to that long-term growth story that I've been talking about. So yes, that is reflected then in general government borrowing as well. And that, as I indicated, development expenditure has been coming down as a percentage of the total, but it has been relatively high and still, I believe, at around about 20% of total spending. Right, so one doesn't want to just dismiss twin deficits as a factor driving currency, but in this environment, I think it's important at least to understand what that deficit is reflecting. Then I also indicated that we'd have a look at global policy, because we've had this unprecedented expansion of fiscal and monetary policy globally that has implications for investments right around the globe. So it might be an odd chart to start with when I'm talking about monetary policy, looking at the total level of government debt in the US. The important takeaway from this chart is that this debt level is the highest it's been, at least since I have history and have been able to access history and the data from 1792, even much higher than the Second World War. Why is that significant? Well, that is significant because we know that there are a number of structural drivers that drive real interest rates. So at the end of the day, emerging markets benchmark off risk-free interest rates abroad. So a starting point for an analysis of capital flows around the world does begin with what is going to happen to likely returns in these developed markets. And we know that these real interest rates in the developed markets are exceptionally low. In nominal terms, some of them are even negative on some of these bonds in Europe. Nominal bond yields in the US are very low, real bond yields low or negative. So very, very low returns. But because investors clearly in these economies are looking for return, when returns are this low in developed markets, then there's always that attraction of higher returns in emerging markets. Understanding, of course, that the high returns does come with more risk, but we have for a number of years now seen the attraction of capital into emerging markets because of this. So we can have a long discussion around structural drivers of interest rates, real interest rates, what determines the desired level of savings and investment in the economy and the interaction of that, which determines where real interest rates are. And one of the important factors that may change in the decades ahead is that as industrialized nations become older and save less, that this global savings glut, in part that had been driven by China in recent years, actually that effect begins to fade, and that savings begins to decline, and that decline in savings eventually puts significant upward pressure on real interest rates. But that's a story for the decades ahead. At the moment, this very high level of government debt to GDP, the only way in a low growth environment that the fiscal maths can add up against that kind of level of GDP is if governments manage to either do an extraordinary turnaround in fiscal policy and deliver very material changes positive changes in their primary budget balances, which you can't really do when you're trying to support the economy in the time of COVID. That leaves you with one alternative. You have to keep real interest rates low. And that's, of course, done with a combination of keeping short-term policy rates low, anchoring the short end of the yield curve, and of course then quantitative easing, which is the buying of government bonds included, also keeps those interest rates low. And I think that this has got legs. Certainly in terms of monetary policy in the US, I think that the Federal Reserve would like to see at least some inflation, significantly more inflation in the system before it would consider tightening policy. And I don't think that happens through the rest of this year and next year. I think that's a story for the medium to longer term. So if we look at Kenya, that does at least eliminate some of the pressure, along with the fact that the consumer price index has been well behaved. The latest number being 4.6%. The outlook is well within the inflation target range, and it's given the central bank the opportunity to lower interest rates. I think that they could possibly do more before the end of this year, although they've done a significant amount to date. We know about 200 basis points since November last year. But against that global backdrop, at least this does give the central bank some space, and if the inflation expectations remain well anchored, that's a very important anchor for the currency. So we're getting to the part where we want to discuss the outlook for the currency itself, and I'd like to begin, as I say, with looking at what the long-term prospects are for the economy. We're positive on that. Yes, we understand the twin deficits, but provided that continues to be more capex-led, that does mitigate the risk there. And then also in terms of, very importantly, the inflation outlook. Inflation outlooks anchor bond yields, they anchor inflation, they anchor currency expectations. Because at the end of the day, if inflation expectations start to rise significantly, that does tend to feed back through into the currency, which does then put pressure back on the central bank. But against this global backdrop of very loose, extraordinarily loose monetary policy in developed markets, it does take that pressure off at the moment. So we don't need at this point, from that perspective, to see the Kenyan central banks raise interest rates to have to stabilize the currency, in my opinion. We know that the Kenyan shilling has been very well behaved relative to a number of other emerging market currencies for a long period of time now. We know that the difference of opinion between whether it's a managed float or a float. At the end of the day, I think that, in my personal opinion, I think the Kenyan shilling has got what I would term, in inverted commas, a liquidity premium. Significant presence in terms of capital markets, and particularly relatively open economy. And within that, I think it also benefits from that a liquidity premium perspective, but it's also benefited from a number of other perspectives as well. Because if you look at the level of reserves, healthy level of reserves around 6 to 7 months, we know that remittances that were well done from abroad were well down in April, but they've started to recover again since then. And also in terms of lending, there tends to be quite a high level of long-term cross-border lending as well. Plus foreign holdings of domestic bonds don't seem to be that particularly high, that domestic currency debt. So essentially there are factors that one would look to, along with the fact that I think that the economy has got that good growth recovery potential, that are significantly supportive of the currency. But all of these factors are very difficult to forecast going forward. We can build an argument that developed market interest rates are going to remain low for an extended period of time, and that policy is going to remain extraordinarily loose. We can make a forecast that GDP growth in Kenya is going to recover. We can make forecasts around the current account, the development of fiscal policy. From these, usually in these forecasts, one ends up making a lot of assumptions, and that does bring risk into the forecast. So from our perspective, the way we prefer to look at a currency is, rather than forecast going forward a bunch of variables to figure out where it's going, is we like to look at, well, is it fairly valued, or is it undervalued, or is it overvalued? And through the years, it doesn't work for all currencies, but for a number of currencies, it does seem to work quite well as a long-term indicator. And that is purchasing power parity. Now, I know immediately that the concern is, well, how do you work out the base year? To get an equilibrium year is very difficult. You could work with a year of maximum employment and a zero current account balance, but there are a number of factors to consider. So we don't work with a base year. What we do is we run a best fit regression over time, and it does seem to, in the long term, give one a reasonable idea of the direction of the currency. At the end of the day, it makes sense. If you're an open economy with an opening capital account, and you're trading with a number of trading partners, it makes sense to me that over time your currency movement will be reflective of inflation differentials between yourself, your own country, and your trading partners. And one can see here PPP done for the Kenyan shilling against the US dollar, and it indicates that the currency is overvalued. It's around about 10%. So it's got a fair value, in inverted commas, here of close to 120 to the shilling. Now, the way to read this would be to say, okay, I'm aware that the currency is overvalued, but at the end of the day, that's only around about a standard deviation away from its fair value. So it's not significant. One only really begins to have high conviction of currency moves when you get to 2 or 3 standard deviations away. And so in this environment, it is possible that, given the positive factors that I've tried to highlight, that the Kenyan shilling doesn't depreciate in the near term to that kind of level. But I think in making investment decisions, it should be borne in mind that it is overvalued, and that there is significant risk that it could move to that kind of level. Timing, we can't really tell, but on a 2-year view, perhaps, or a 3-year view, even before, as I say, we don't really want to talk about timing, but we do want to bear it in mind when we are making investment decisions. So just as far as the long term is concerned, what we've seen globally, as far as currencies go, and this has been reflected in currencies in sub-Saharan Africa in general, just as a final comment, I mean, we've seen a bit of a period now where we've had a bit more risk on. So as it became evident that emerging market economies, yes, they're being hit with a lag to the developed economies with COVID-19. Yes, it'll take them longer to recover. But what I tried to show up front was that we're already beginning to see the indications of the economy recovering. When we look at the mobility maps, it's a reasonable expectation that as you open the economy, that would happen. And as this message has come across to investors across the world, we've had this bit of a risk on period. Many spreads, credit spreads in emerging markets have been high. Supply not especially robust, clearly at a time of COVID. And also with IMF involvement in many economies and also some other indicators tending to suggest that maybe the near-term debt dynamics are manageable. Risk appetite has recovered in this environment. We are heading into a period of the year where there's a bit more risk building again. I mentioned US elections, China-US trade tensions. So maybe a lot of that stabilization process is already behind us. And there are certainly in some cases, for example, in Nigeria, one believes that perhaps one could get further adjustment there to the currency and also some of the other currencies potentially. So one has to be aware that period is also perhaps drawing to a close, this period of risk on that has supported currencies. But nonetheless, at the same time, one must also remember the key point that I try to make was that our economies, many of our economies do offer significant returns relative to those very low or negative real yields in developed markets and in the US in particular. And then just my final comment would be that in the longer term, and something that would fit into the currency view that I've tried to express on the Kenyan shilling, is that one has to watch fiscal risk in the longer term. It was necessary to respond to COVID-19. It has hit revenue very hard. This is not unique to Kenya. It's happened in a number of emerging market economies around the world. But of course, over time, it is necessary that we do see fiscal consolidation and not a continued increase in the debt ratio. As we saw in South Africa, for example, if one allows that to continue for too long, you end up with continuous downward pressure on your sovereign debt rating in your currency, and in the longer term, that also highlights inflation risk. So this is an important thing to bear in mind in the longer term. That's my presentation. I've just tried to sketch a few of the ideas around how we think about the currency, the main drivers, and then also try to just to show you how we prefer to look at the currency and how we think is a reasonable way to consider the Kenyan shilling.
Okay, thank you, Arthur. Thank you so much for that detailed presentation. Now we go to the Q&A section, and I just want to reintroduce Mr. Mark Muller, who is Managing Director, Sanlam Private Wealth. Mark will be useful with respect to questions of what investors can do now, given the information that Arthur has shared, and Arthur will respond to the more technical macro questions. So starting off right away, we have 3 questions on the shilling from Raj Shah. I'm just gonna read out the questions, and then I hope Arthur can answer them. So the first question is, what is the reason for the breakdown in correlation between USD Kenya shilling and USD Uganda shilling? So he points out there is a breakdown in correlation there. And what, in your view, is the reason for that? Arthur?
Okay, so I'm assuming when we talk about the breakdown and the correlation, is it between, I'm not quite sure whether that means that the dollar's, the dollar's been weak over the last number of months. This is an important observation because in that environment, one would have expected emerging market currencies to do better. Now, obviously, the Kenyan shilling, along with other emerging markets, has depreciated over the course of this year, despite the weak dollar. And I think the reason for that is it's number one has to admit sometimes things are a bit more surprising than what you can imagine. But I think one of the key reasons is just the impact of COVID. I think that this was a material shock, and as investors had to reassess long-term potential investment returns in economies, that one has seen currencies depreciate. And I think as it becomes more obvious that these economies can recover, I think that that relationship could perhaps break down a little bit again. But the point being, in our case, though, I'd still emphasize that in Kenya's case, it does look like an overvalued currency to us. It's probably an appropriate time to make a few comments around the dollar. So the key question then here is whether the dollar remains weak and whether it continues to weaken further. So in this score, number one, I must say, from the perspective that we look at it, we think the dollar is still an overvalued currency, but not by a lot. There are cyclical arguments that it could weaken further. One of those is just the fact, obviously, of zero-bound interest rates and also quantitative easing. But then again, you would argue that other developed economies are also embarking on quantitative easing and also have zero-bound on interest rates. So I don't think that's really an argument for further dollar weakness. There's an argument that the current account deficit should result in further dollar weakness. Well, the question is, why now? Well, if you don't get sufficient capital inflows and you're running a current account deficit, yes, the currency will weaken. But we must remember that the US earns a far higher yield on its external assets than it does on its liabilities. And so the present value of the future income stream of that is significantly positive and helps justify the current account deficit. So I'm not sure that that is a strong argument. And then the third argument that gets made is that a number of central banks around the world are no longer or are holding less dollars. They still hold dollars, but they're holding less dollars. That's true, but the dollar is still the dominant reserve currency. It still has that liquidity premium. And there's no obvious alternative at this point. In China, one would need a more open capital account, even deeper, more liquid markets. Europe would need, there are latent risks there that need to be addressed. A move towards a fiscal union over time would help address that. But neither of those two, which would be the obvious choices for alternative reserve currencies at this point, I think are ready to fill that gap. So cyclically, you can build an argument that maybe the dollar does weaken. We still think that from a PPP perspective, it's overvalued. But I'm not sure the dollar goes through a big structural break weaker at this point. That's not my base case view. But yes, it has been surprising that as the dollar has been weaker, that that one has seen, for example, maybe a more, a stable Kenyan shilling. But, I also, from that perspective, I'd like to just emphasize that we do think that Kenyan shilling is a bit overvalued. I'm not sure if I understood that question correctly. If I didn't, please just ask it again.
So the relative amount of depreciation of the Ugandan shilling compared to Kenya. So Kenya seems to have depreciated more this year, 7%, which, is atypical. So the question is why? Is it that, in your view, the Kenyan shilling has more of a valuation?
I think the key reason here is that is COVID-19. I do think that has been the key reason, and capital flows, and because Kenya is a significant market in terms of attracting capital. It's not that Uganda is an insignificant market. That's not the reason. But the Kenyan shilling, Kenya is in terms of its capital markets more integrated with the rest of the global economy, and therefore I think from that perspective, it probably reflects the reaction of investors globally and capital flows globally to COVID-19. So one has this in South Africa as well, for example, that the more liquid markets tend to get hit first, almost in some cases as a proxy for the other markets in terms of investor positioning.
Okay, thank you. So another question from Raj Shah. Has the central bank interference in banks' trading activity over the past few years and this year contributed to higher volatility of the Kenya shilling?
Yes, we've had this. It's a good question. Because we've had this debate in South Africa as well, and so central banks very often interpret it as dealing with liquidity and volatility issues, and not trying to change the structural direction of the currency. And I think that that's a fair argument to make in the case of Kenya, that the central bank intervention is not aimed at trying to alter to drive the currency away from where its fair value is. As I say, we think the currency is undervalued, but it's only around about, overvalued, but it's only around about one standard deviation overvalued in our view, which is not a lot. So in our opinion, there's no indication there that the central bank is trying to shift the currency away from where its fair value is. So I think it's a fair argument that it's around volatility and liquidity management.
Okay, so the follow-up question from Raj Shah is, should the central bank use reserves to defend modest depreciation in the currency, especially considering that the reserves have been historically accumulated through borrowing at very high USD rates? Should they use reserves to defend modest depreciation?
Again, a good question, a debate that we've had in South Africa as well. It becomes more difficult, and the point has been made about borrowing at high rates. It becomes more difficult the more integrated you become with the global economy, because the more integrated you become and the more dominant capital flows become on the balance of payments, the more difficult it is to manage the currency by use of reserves. I certainly wouldn't use the reserves to try and change the structural direction of the currency. That, I think, in my opinion, in South Africa, we went through a long period of time where we tried to do something similar to that, and ultimately that was a policy that we let go because it wasn't effective. In fact, it causes more volatility ultimately.
Okay, so given what you've said with respect to the overvaluation, if the central bank doesn't aggressively defend against modest depreciation, how much volatility would you expect to see over the short-term horizon?
A very difficult question to answer. We use our fair value as a guide, but we know that exchange rates will overshoot from time to time. But at this point, a significant amount of the adjustment has taken place. If we look at where the currency was late last year and we look at where the currency is now, a significant amount of that adjustment has taken place. Yes, within a very difficult environment. But nonetheless, from the beginning of the year, we're almost halfway there. And so obviously the risk is that, if one has an overshoot in this environment, it would be very difficult for the central bank to respond by raising interest rates. So this is why I mentioned monetary policy earlier. If a currency depreciation goes too far and it starts to raise inflation expectations too much, and you start to undo inflation expectations longer term, that can be quite damaging in terms of a feedback loop back into further currency weakness and a weaker economy. So ultimately, if you need to respond, you may ultimately need to do that. It's not my opinion that we're at this point. And in fact, as I've indicated, I think the fact that US monetary policy is going to remain very loose for an extraordinarily long period of time, until inflation picks up more significantly. That's always a risk. But that also at least does help mitigate the need for too aggressive a reaction. So the way I would put this is, at this point, the depreciation we've seen to date has not unhinged inflation expectations. A robust economy should be able to take depreciation of this magnitude in its stride. If it goes too far and we're not there, If it goes significantly too far and you start to see inflation expectations rising and you start to see that feeding back into further currency weakness, you may have to act at that point. But I suspect that that would not arrive soon if US monetary policy remains as loose as it is.
Okay. So the other topical issue in Kenya today is around levels of debt. And I can see a few questions on that. So I just want to take them at the same time. So number one, could Kenya's growing foreign debt be a source of concern for the currency? In your view, are Kenya's and Sub-Saharan Africa's external debt refinancing obligation a cause for concern?
So this speaks directly to the ability to fund your foreign currency debt in particular. That would be important. Now, there are significant, in the years ahead, in the medium to longer term, there are significant redemptions. So you clearly need a sufficient level of foreign exchange reserves for that. And so clearly that at the time, the question is adequacy of reserve levels. And ultimately, if one lets one's foreign debt build up continuously and one's reserve levels are not sufficient to match that, then that does start to speak to some risk. But also a lot of that debt, as far as I can tell, is also of a bilateral nature. So one also has to take that into account, which does tend to mitigate the risk, in my opinion, to an extent. But it does speak to the need for fiscal consolidation. We know that the deficit had to widen this year, that the support for COVID-19 projects, including also helping the economy through, the VAT rate cut also helps. And these measures were necessary in the near term to also lend support to the economy. However, if the deficit projections I'm seeing are continuously going up. And, in the medium term, you can't keep a deficit at 7 to 8% of GDP, especially at a time if development expenditure is starting to come down. I've indicated it is high as a percentage of total expenditure in Kenya. But if one continuously moves towards more consumption type spending and less capex spending and continues to run that fiscal deficit at those high levels, then there must be significantly more risk in the longer term, especially since the overall public sector debt level or government debt level is probably going above 70% of GDP in the next couple of years. That's the sort of level at which investors start becoming uncomfortable. So ultimately, your ability to service your debt will mean on how much your level of reserves is, which is a function of how much capital can you attract, which is a function of how well one's running one's economy and how well one's economy is growing. So I've tried to build an argument that the return should be there in Kenya in the longer term in terms of potential growth, which should help to continue attracting capital. But if one continues along a fiscal path where there's not sufficient fiscal consolidation, and there has to be more, in my opinion, fiscal consolidation in the years ahead once the economy is up and running post-COVID to mitigate the risk on this front. So that also does feed back a little bit into currency risk, especially in a few years' time where there's some very large redemptions. One has got to be aware of that. That's why my last chart, in fact, was on fiscal policy and on the government debt level. As a medium-term risk, it remains significant. So bottom line is one needs continuous access to foreign capital. That's the important point. And one must make sure that over time, if you are running a current account deficit, that it's reflecting development expenditure, which keeps the potential growth rate in the economy high. If one starts to drift increasingly into an area where the fiscal deficit is reflecting consumption spending, and that's reflected in the current account deficit, that becomes problematic.
Okay, thank you. Thank you so much. So honing on the message a little bit here, we do have a lot of money managers, local money managers on the call. And as we were talking earlier, I told you that they are in a very tight spot because the equity market is fairly thin in terms of investable options. And we do, especially this morning, have seen that the banking sector is expected to underperform significantly this year, which makes equity positions dubious. Then we do have potential political risk in terms of upcoming elections, maybe perhaps upcoming referendum campaigns. Is this a good time for them to think about allocation to offshore assets? And what would you advise them with respect to going around that form of diversification?
So in terms of offshore assets, clearly one starts with the currency. So our discussion on the currency is pertinent here, bearing in mind that our view is that the shilling is overvalued, not greatly, but to an extent. And so one must take that into account in investment decisions. Then in terms of global asset allocation, this is a very difficult time to allocate assets or capital abroad. So if you look at it from our opinion, if we look at the global economy, if you, for example, look at the US equity market, now we like to do valuations from a very long-term perspective. And when I say long-term, I really mean long-term. I mean 100 years and more. And the reason for that is, especially at a time like this, when you're in a situation where you've got something as extraordinary as COVID-19, we like to look back on history that includes the Great Depression, the two world wars, the global financial crisis, the pandemic of 1918, and some other pandemics in between. And when one views it in that light, then, for example, the S&P 500, in our opinion, is overvalued. So in terms of global equities, particularly DM equities, we're underweight. I've spoken about bonds, negative in risk-free bonds, negative to low to negative real returns. So again, there one's looking at an underweight position. Global property, one is neutral because there's structural factors that are at play there. Working from home, perhaps less retail space needed. And so we actually have a significant overweight in foreign cash. And obviously the risk-free currency is cash. So from that perspective, it's reasonably defensive. And I think that's illustrative of an environment where if one is looking for return, one therefore is going to take on more risk. And so this is why some investors would look at emerging market assets and high yielding currencies in this environment. And in some cases, these high-yielding assets are giving significantly high returns. One does need to be cognizant of the risks in them, though, and we're all very well aware of those risks. But the one that I would highlight is certainly on the fiscal policy front. I think one needs to differentiate between economies that are going to be able to rebound from COVID, have good long-term growth fundamentals, combined with, because that makes it easier for them to do fiscal consolidation, as opposed to those economies that have got poor growth prospects, are not going to rebound easily from COVID-19, which makes fiscal adjustment that much more difficult. So I would make that differentiation. But in a world where returns are so low in the risk-free markets, investors, increasingly would need to look at higher return markets, emerging markets, but cognizant, obviously, of the risks in them.
Yeah. Now, and so in terms of global equities, and this I think is the last question in the queue, the technology sector has done well during this COVID-19 pandemic. Which other sector do you feel is undervalued now or stands to bounce back quickly? I think you've alluded to that, but if you can say a bit more on that after COVID-19 and offers good entry positions for a 2 to 3 year investment horizon. I think I can also bring in Mark to contribute to that question as well.
Yes, so certainly I can comment. I'd like to refer to Mark on that one.
Okay.
I can give some of my own thoughts on our positioning, but in terms of our broad positioning, I've already indicated we prefer the underweights, but there are particular sectors that we would look at. I can let Mark go and then fill in after that.
Thanks, Arthur. Yeah, Arthur, I echo what you said. We've had a position. I think we've had a couple of presentations from our equity managers from the Sanlam Global High Quality Fund, who have had significant growth in the technology sector. If one compares that to other asset classes. And we still remain in those asset classes. And then just to if I can answer that question, then Arthur, I'm happy that you fill that in. But just to add something further, and perhaps to put back to you, Arthur, the one question that came through from one of the questions that we saw was in terms of offshore investing. I just wanted to give my view, and then would be happy to take your and Edwin's view on that as well. Is that the departure point is always that you need to have a diversified portfolio, so that where one has got concentration risk with respect to a particular currency or asset class, that the prudent investment manager will never propagate that position. So, if we're asked the question, what is our view on offshore investing for a Kenyan investor? Certainly we say prudent investor diversifies. And then, that combined with what we've heard from Arthur being the shilling, which is looking at possibly being overvalued, one needs to then invest into harder currencies. Where we invest, we've heard from Arthur again that there's particular areas within equities that we need to look at. But then you need to be skilled as a fund manager, and as I said, we've looked at those areas quite closely. The technology sector is one that we have had good success and growth within this year. Bonds, we're short on bonds, but cash we've moved a lot of our client monies into cash funds. Sanlam has a couple of its own cash funds which have done well. So, to answer that question in a nutshell, technologies is something that we certainly are looking at. We do think that there is still room for growth. We do feel that the long-term prospect on, as Arthur said, return to work and so on, that might be something which has changed, and technologies such as the medium that we're on now at the moment, that might become more prevalent. That's going to become, and apologies for the cliche, but that's going to become the new normal. So we do think that there's scope there. And Arthur, I don't know if you want to supplement anything I've said. I've tried to paint a broad brush over a number of issues, I think, that I've seen in the questions.
So thanks, Mark. So when I would look at it, I would say, let's look at the S&P 500, for example. So the bounce back in that and the rally in that market has been quite narrowly focused, and quite rightly been pointed out that tech has been part of that. What we have looked at since the beginning of this quarter in terms of tech is, and clearly, one needs to do one's homework per company, and it's not a blanket call, but where we've seen from a valuation perspective, one can look for opportunity would be in EM tech, emerging market tech, some tech space there. And then also in terms of valuation, also something we've looked at since the beginning of this quarter is the financials in the US and Europe. Some of them have also looked cheap. So one is going to have to be very selective, but within a broad and overall understanding that we are underweight global equities. And so, as I say, it is an uncertain time to invest. And one of the key reasons for that is the lack of clarity on future earnings and cash flows. This is the significant problem at the moment. We know economies will recover from where they were. If you shut businesses down and we open them back up again, we know that they will come back online and they will earn again. But the long-term future cash streams are very uncertain. And it's one of the things that I pointed out in the presentation, for example, and that is that 1918 taught us that over 2 years you could get 2 or 3 waves of COVID-19. Also, monetary policy and fiscal policy support will be wearing down by the end of this year. And you can't continuously just keep doing that, because these debt levels are getting very high, even though you're managing to keep real interest rates low and make the fiscal maths work out. At some point, this creates significant risk. And one of the risks that's bringing into the system is potential inflation. So amidst all that uncertainty, our overall positioning is very conservative, as I've indicated, also with that overweight in cash, foreign cash. But if one is looking within the equity space, that's where we have been looking for opportunities, is in EM Tech and in financials in the US and Europe. With the usual caveats, you know, one needs to do one's homework and be selective on a company basis.
Okay, so thank you so much, Arthur and Mark. I think we are coming to the end of the webinar. We do not have any more questions, which I can only take to mean that the presentation has landed very well. I do see one that has just come in now, asking if we can have the recording. Yes, we will be sharing a link to the recording. We will share the presentation as well to those who attended the webinar. And we are certainly available to discuss one-on-one in case you have further questions. In case you do want help with respect to what you do next with respect to your investment portfolios. So I want to thank Ada for a good presentation, and I want to thank Mark for coming in to help with the questions, and the rest of the team at Sanlam Investments, Sanlam Private Wealth, and Darren Blair Investment Bank. For our audience, thank you so much for joining us today. Do let us know if we can be of help in any way, and we will get back to you. Thank you.
Thanks very much, Edwin. Thanks, Arthur. Lovely listening to you.
Thanks, Edwin. Thanks to everyone who listened.
Cheers, everyone.
Bye-bye.